Parkson Holding Berhad is a leading Malaysian-based retailer specializing in operating and managing department stores. It has cemented itself as a key player in Malaysia's retail industry, offering high-quality products from both international and local brands. Recently, Parkson has focused on enhancing its digital presence to adapt to the evolving retail landscape. AEON Co Berhad is one of Malaysia's leading retail company specializing in hypermarkets, supermarkets, department stores and convenience stores. It offers a diverse range of products including groceries, household items, fashions, electronics and beauty products through well brands like AEON and AEON Big. With a robust corporate governance model and key departments focused on retail operation, marketing and finance, AEON is a trusted name in the retail industry.
First, Parkson's current ratio shows an decline from 0.660, 0.95 and 1. This ratio suggests there is a gradual improvement in the company's liquidity position. Okay, next is the current ratio of the company. AEON has not shown any improvement over the 3 years starting from 2021 until 2023, which is hovering around 0.5. This ratio suggests a liquidity issue of the company, meaning that the current assets are insufficient to cover the current liabilities. Leverage ratio. I will explain about the debt ratio of the two companies. First, Parkson company's debt ratio climbed marginally from 0.7 to 0.72 between 2021 and 2023, then stayed steady at 0.72. The debt ratio's steady increase suggests that the business has been using more leverage over time. Okay, for the AEON, the company's leverage has steadily declined, as evidenced by the debt ratios drop from 0.7 in 2021 to 0.74 in 2023. This pattern suggests that the business is making a concerted effort to lower its debt load in relation to its total assets. Okay, this is profitability ratio. Parkson during the 3 year, we can see the poor performance is highlighted by the company, which is decreasing in ROA, which went from negative 0.01 in 2021 to negative 0.02 in 2022, and then a neutral 0 in 2023. Okay, for the AEON, from 0.01 in 2021 to 0.02 in 2022, and then to a stable 0.02 in 2023, the company's ROA showed a continuous improvement. Alright, the next part is the account receivable turnover. For Parkson, the company's capacity to collect payment from the consumer has deteriorated as seen by the dropping receivable turnover ratio from 2021 to 2023. This is a worrying trend that could point a change in lending policy that isn't working, possible liquidity problem, or the one linked clienteling. For the AEON, over the course of the 3 years, the company's receivable turnover ratio demonstrates a great capacity to recover receivable efficiently. Although there was a minor drop in 2023. Last promise is the return of equity. Okay, for Parkson, for the first 2 years, the company's financial difficulties are indicated by the negative ROE in 2021 and 2022. The business was unable to turn a return on its equity, and the growing losses in 2022 point to deteriorating circumstances, which could be brought on by the ineffective management, and so on. Okay, for the AEON, over the past 3 years, the company has shown strong and steady profitability with rising ROE and high level stability.
Let's start with Parkson's income statement. Parkson's revenue experienced a sharp decline of 39.36% from 2021 to 2022, indicating significant challenges, possibly due to economic downturns or the effect of the pandemic. However, there is a small recovery of 6.82% in 2023, signaling some improvement, although it still hasn't fully returned to 2021 levels. In terms of profit from operations, Parkson experienced a substantial 54.75% decline in 2023 compared to 2021. This was a significant drop, reflecting operational struggles. However, in 2023, we saw a recovery with a 6.82% increase, suggesting that Parkson is improving its operational performance through those still facing challenges to reach the performance seen in 2021. Next, turning to AEON's income statement. AEON's revenue grew by 14.07% in 2022, but saw a slight dip of 0.29% in 2023. This aligned with their profit from operations, which saw a strong growth of 23.85% in 2022, followed by 10.36% decrease in 2023, indicating some volatility.
Looking at common sense analysis, in 2021, a massive 76.62% of Parkson's total assets came from its total non-current assets. However, the number in the next 2 years, in 2022 and 2023, decreased to 72.80% and 70.45% respectively, indicating that the company is shifting away from long-term investment. The company also recorded a high level of total liabilities, which the number stands at exceeding more than 70% over the 3 years. This indicates a high reliance on debt for the company. As for AEON, in 2023, the company recorded a high level percentage of total equity at 35.59%, which massively contributed hugely by the retained earning percentage of 21.18%, which this indicates the company good profitability. In overall, AEON is doing well in increasing its percentage of total equity, while at the same time decreasing its percentage of total liabilities over the period of 3 years.
Both Parkson Holding Berhad and AEON Corporation Malaysia Berhad are well-established companies with strengths and area for improvement. Parkson operates on a larger scale with a significant asset and liabilities. AEON, on the other hand, has demonstrated strong revenue generation capabilities but faces liquidity challenges as evidenced by its low net current asset ratio.
In conclusion, our comprehensive financial analysis indicates that AEON Corporation Malaysia Berhad outperforms Parkson Holding Berhad in terms of financial performance and stability. While AEON's liquidity is slightly weaker than Parkson's, its consistent ability to generate stable profits over the year suggests that its liquidity and overall financial strength will improve over time. With its strong financial performance, AEON is well positioned to attract more investors, and with continued innovations and executions, the company could achieve further growth. Moreover, AEON's strategic financial planning has notably reduced its reliance on debt, which we find particularly impressive.